Hello there. We are live. We are so live that we are livin', we are jiving. I don't know. I can't think of anything funny right now. It's been a long day, but a good day, an interesting day. We've got a couple of things to cover. First of all, Amazon hit a new all-time high today. It's significant, and I'll tell you why. Some people could be like blasé, hey, yeah, big deal. So the stock hit a new high. No wonder, it's Amazon. There's some significance here. Okay. Jim Cramer of Mad Money, of whom I am a fan, by the way, of Jim, and he's incredible. But he has thrown in the towel from calling for a test, a bottoming test, to saying, you know what? Maybe we're not going to retest the lows. What else do we have? I want to talk to you about something from the JP Morgan conference call today with their incredible CEO, Jamie Dimon, about when he expects workers to get back to their offices. And on a personal finance note, I've been seeing a lot of back and forth between what's more important, having your emergency fund cash in the bank or paying off high interest credit card debt. We need to settle this once and for all because I don't agree with a lot of the things that I'm seeing around here. So without further ado, let's get into the show and let us roll the introduction. So Amazon hits a new all-time high. I'll show you the quick screen share. I love my screen share. Wait, hold on a second. I don't want to show me because that interferes with it. So let's just separate this out here, okay? Yeah, move. I have a couple of screens in front of me, folks. So now we're going to do a quick screen share. Share screen, share screen. Okay, you see that? We haven't seen one of these yellow lines for a while. It says new 52-week high. Amazon up over 5% today, up over $114. It's up a tiny bit in aftermarket trading. If you think to March 23rd, which so far is the bottom of this bear market, and it was only like 3 weeks ago, okay? Well, I can't believe it was only 3 weeks ago. It feels like it was a year ago. We thought we would never see highs again in anything. It was all over. We would see, the thought of new highs could be years into the future. Why is this significant? Well, it's Amazon. Everybody's ordering from Amazon, and we're living on Amazon Prime. It's all we have to go by today, right? And Whole Foods, Amazon Fresh. So, but Amazon, there's a lot more to Amazon than just online shopping. They have their cloud business, which is massive, and that's really the profit generator that's funding everything else for Amazon. The point is, this is when a new general has arrived to the battlefield and has taken leadership. That's how stocks are often spoken about, by the way. A lot of military terms, stocks are advancing, stocks are retreating. The generals are leading, the generals are retreating. The soldiers have to catch up. A lot of military terms. So Amazon is the market's new hero. And the market, it needed a hero. And I remember in early 2003, after the big tech wreck, and that was a massive tech wreck. I mean, the NASDAQ went down about 80%. Okay, think about that. One of the major averages going down 80%. By the way, the NASDAQ, S&P 500, Dow Jones, these are indexes. You cannot invest directly into an index, but you could invest into a security that tracks or mimics an index, okay? So the significant thing about Amazon, I could stop the share screen. The significant thing about Amazon is it reminds me of back then of Google. Before Google changed its name to Alphabet, in early to mid 2003, all of a sudden Google started galloping ahead and hitting new highs. And I remember saying to one of my coworkers, Michael, I remember saying to him, and hey, Magoo, if you're watching, this is for you. I remember saying to him, the market needed a new leader, a new hero, and Google is giving it to them. Well, I'm saying that now, but with Amazon. I mean, new high. This is incredible. But it speaks to a bigger point that investors got too negative, sold out of too many stocks, and now they're rushing in. They're buying them back. And they're buying them back hard and fast with volume, with tenacity, with gusto. I don't get to use that word too often in a live. And now also, and by the way, if you're watching this in the live stream, I would like to welcome you to the show. This is an episode of Be the Boss of Your Money. If you have any questions, words of encouragement, that's what the comments are for. I'd love to get into some banter with you. That to me is always a lot of fun. And if you're watching this from LinkedIn, welcome to you. Facebook, welcome to you. YouTube, welcome to you. So welcome everybody. If you're watching this in the replay and you have a question, hit me with a question there. It's just like watching it in the live. I will check for your questions and I will get back to you. So the second thing is, a very popular market person, Jim Cramer of Mad Money of CNBC. We all know who he is. He's been calling for a retest back to the March 23rd bottom. Now, if you recall, I've reinforced this a number of times for the show that the following day, March 24th, I said, I think we hit a bottom, because if you look at all the Fed stimulus, the fiscal stimulus, the monetary stimulus, fiscal comes from Congress, government spending, and monetary stimulus, with interest rates and quantitative easing, that comes from the Fed, so it's monetary. If you look at that, and I said, I think we hit a bottom, because if the government is going to take over the private sector, and that means there was no reason to sell off stocks as much as they did. And now if we see a flattening of the curve with the coronavirus, the COVID-19 situation. Again, I choose my words carefully because it's still a horrendous situation. It's just very horrendous, but people are inferring from the graph starting to level out that it's not as horrendous. But that's, if you take all of that, and with the people getting back to work, Fed stimulus, that's a very powerful combination for the stock market. Someone said that it kills all the fun of price discovery because you have the Fed coming in and saving the market, basically. Okay, well, whether if you like it or not, there's an old expression: you have to trade the market you have, not the market you want, and that's what we're doing now. So Jim Cramer changed his mind, and let's just take a quick look at that. Okay, at what Jimmy said. I'm going to show you something real quick in the stream. Okay.
Percent. I got to wonder, have we already bottomed? I mean, isn't that the big question? That's what I heard all weekend. For a while, I was operating on the assumption that the recent rally might be temporary, that the S&P would revisit its March lows of 2,237, perhaps even taking out that level. I figured a retest was virtually, let's just say, inevitable. There was just too much weakness in the system all through here. We just knew things were going very awry. But now I'm feeling more confident about the future. I said it this morning on Squawk.
Okay, so there you have it. Now Jim Cramer's on board. Yesterday we spoke about Goldman Sachs, David Kostin, and Kalanovic from J.P. Morgan getting on board with the narrative that stocks have bottomed. Look, I wouldn't bet my life on it. Okay, if we see a retest, it's going to be ugly. People are going to throw up their hands and say everything we thought that could go well has become a major disappointment, and that's it. We give up hope, and the market goes lower. That could happen. The further we get from the 3 weeks ago, March 23rd bottom, I think the harder it becomes. So instead of just becoming paper thin, it becomes like a cement floor, and hopefully acts as a support for the market. Okay, so that are the first two things. So we have Amazon hitting new highs. It's significant. We have a new leader, a new general. I think Amazon is like it creates like a vortex of it's like a, I don't know, how would you say it pulls everything up with it. So if Amazon goes up, Netflix hit a new high yesterday. If you start seeing that, you start to realize that there is upside potential in stocks. I think these stocks start to pull everyone else, almost every, a lot of stocks with it. There are some stocks that I look at and I don't even know why these companies are in existence anymore. There are a lot of zombie companies, but that's a story for another day. So what else? I want to show you something that Jamie Dimon mentioned in his conference call. They came out with earnings today. And what did he say? He said we have to do a share screen. Share screen. Okay. I want to just highlight this. Okay. Jamie Dimon says here, it's probably too small for you to see on your screen, but right over here, I don't know if you can see this, what I'm highlighting over here. Okay. A rational plan to get back to work is a good thing to do, and hopefully it will be sooner rather than later. Dimon said on Tuesday in a conference call with analysts, but it won't be May. Well, I think we have given up on end of May. Well, a lot of us have, but we're talking about June, July, August, something like that. The point is, when companies start going from we're never going to get back to work to planning to get back to work, that alone, that alone is a big psychological driver, a positive economic and investor psychology factor that also helps reinvigorate investors and pushes them into a more bullish posture. And now the last thing I want to cover is personal finance, because you're watching Be the Boss of Your Money. So you always have to ask, are you the boss of your money, or is your money the boss of you? It's very easy for money to become the boss of you. It's not as easy to control as people think. Okay. So we stop the screen share. So I've been seeing a lot of people, and I saw one video that was excellent by someone who I respect a lot, that talked about the difference between having some cash in the bank and credit card debt. And this person's view is that, credit card debt with a 15 or 20% interest rate versus cash that's making nothing, it's a no-brainer to use that cash, move it to the credit card debt, get rid of the credit card debt. And this is a tough time, and maybe people got into some credit card debt because a lot of people have lost their jobs. It's a tough market. Not everybody is sitting on a ton of money. And I know a lot of people who do own businesses that are really shell-shocked right now. And so maybe they're using some credit cards to get through the next month or two. Well, I disagree with that. Yes, obviously, you're not going to outrun 15% interest rates or 17 or 20% on a credit card with just about anything. So, if you have cash, you should obviously, that's earning nothing. You should stop spending money on the interest. But what about, an emergency fund? I'm a big believer in having the emergency fund in the bank. Even if you have credit card debt, it's okay. You have to have some kind of cash in the bank, because like we saw in 0809, 07, 08, 09, credit card limits were reduced. Credit lines, lines of credit were eliminated. HELOCs were, if you didn't use the money, they were also eliminated. And sometimes a credit card just doesn't work. So I think an emergency fund is important, because if you solely rely on a credit card and you are SOL with the debt you have in the card, or the credit line is pulled from you, your credit limit is reduced, then you have nothing. And then you're really up the creek. So I want to make sure that people, you have to have both. I think you have to keep an emergency fund, and when you get to that point, the rest of your cash would go toward paying down debt, consumer debt, maybe your mortgage, what have you. But I think it's important to have the cash. So that's my take on this. I'm going to just take a quick look at the comments. Hey, Liz, great to see you. I love it that you are watching and enjoying. I really appreciate that. Thank you for the heart. And hey, Beth, great to see you out there as well. I always appreciate when my fellow live creator, my fellow live streamer is out there and taking a look at the stuff. And we'll just real quick, we'll see if anybody's out there in LinkedIn land. So I don't know if you noticed, if you notice the background, this is like the first really nice day in a couple of days. We had a horrendous rainstorm yesterday on Long Island. The weather is beautiful. It is sunny out. It's gorgeous. So I have a sunny picture of the New York Stock Exchange right behind me. So let me take a look. We've got a few people out there in LinkedIn land. Okay. Hey, Frank, great to see you. And hey, man, you're very welcome. Frank says in LinkedIn, thanks for looping us in daily. Dude, thank you so much. I appreciate you, those kind words. You're very welcome. Jay Spinney, market needs a hero, and his name is, his name is Mitch Goldberg. Look, he wrote that. Can you see that? Can you see what he wrote? Can you see what Jay wrote? I don't know. There's a little bit of reflection. Okay, you can't see it, but thank you, Jay. That was really sweet of you. Thank you very much, my friend. And hey, Ivana. Hi, Mitch. Some stocks all of a sudden actually look expensive. What do you think? Okay, well, okay. That's how we'll maybe end it on that. Okay. Yes, but I want to talk about PE ratios. Okay, and we'll talk about Amazon. We'll lead into that. Amazon has always been considered overvalued and high valuations. It's never been considered a cheap stock. I don't like cheap stocks because there's an old expression, cheap for a reason. I know you know this. You know this. I know you do. So I'm not trying to lecture to you. Just for people who are watching who don't know the stuff yet. We don't speak our language. So as what's happening now is you could take $100 stock and maybe they're earning $10 a share. So it's a PE multiple of 10. And now you go into a recession, the stock might go down to 70, but their earnings go from $10 a share to maybe zero or maybe losing money. So let's say they make a penny, for example. So you have $70 divided by a penny. It's, 7,000. I mean, yeah. So that's a massive PE ratio. So when you have an earnings contraction, it makes stocks look really expensive. That's one of the reasons why Professor Schiller from Yale uses his CAPE ratio, because he takes a 10-year average level of earnings to develop his CAPE ratio. It's a PE ratio, but instead of using current earnings or forecasted earnings for the next year, he uses trailing 10-year average earnings. So yeah, some stocks could look expensive. And then you also have to think of in terms of how much business is being squeezed into Amazon coming out of other retailers. And how many people have squeezed out of the movie theaters and into Netflix. So, maybe people's behavior will change and we'll start watching less Netflix. We'll start using less screen time because we'll be out of the social distancing. That could take a while. Or maybe some of these habits that we've developed will stick around and we'll work more remotely. We'll use DocuSign and we'll use Zoom and GoToMeeting more often. So that remains to be seen. So yes, some stocks are starting to look expensive. I think some are looking more expensive for a good reason. Some, of course, will be for a bad reason. And some will just look expensive because they're taking a temporary hit to earnings. So if the price is the numerator, the denominator is the earnings. If the denominator plunges, you're going to have a much higher PE ratio. And then you'll say, oh, that stock looks really expensive. This happened, by the way, in 2009, where a lot of industrial stocks looked very expensive with sky-high PE ratios. But that was just because their earnings were down and out. But when you got into 2010, 2011, you saw the earnings come back. And that was a really powerful catalyst for these stocks to go up, those kinds of stocks. So anyway, I'm going to end it here. I don't see any more comments out there. Oh, Frank is out there. Let's show his. How do we know what the E in PE is right now? Wow, Frank, that is like the $1 trillion question. We don't, because right now companies are coming out with their forecasts going forward for the rest of the year, and they're saying things like, we are officially withdrawing our forecasts. We have limited visibility, or we have no visibility. And so a lot of this now is kind of a patchwork of guesses to see what companies could actually earn. A lot of it is based on faith that companies like a JP Morgan or, other companies, other blue chip type companies that will survive and recover. But with the prices so low, even if they don't recover fully to where they were before the coronavirus, that it'll be good enough to send the stocks higher because the stocks are cheaper now. So that's what That is, it's really hard to know what the earnings are, and that's why there's some guesswork involved. And that's why one of the reasons we use the CAPE ratio from Professor Schiller of Yale, because he takes a 10-year average to smooth out the volatility of recessions, and economic expansions. Okay, so that is it. Total fiction. So investors must get back on a long-term plan, right? Yes, sir. You are definitely right about that. Completely agree with you. The only way to really inoculate yourself from this volatility is to become a long-term investor. On that note, I'm going to let you guys go. We hit the 20-minute mark, and I thank you. I'll be back tomorrow, 4:30. Would love it for you to join me again. Bye.